Welcome to the Leaders in Housing Counseling call. We're very glad you're here. We have a very strong turnout today. We're going to dive right in. It's a crowded agenda. Our goal today is to really do a deeper dive into the new rules of the game for FHA, for Freddie Mac, and for Fannie Mae around FHA and conventional mortgages. So all the forbearance programs, what's changed, what's new, loan modification tools, foreclosure issues. We want to kind of give people the full rundown. I know some of this we've put out on writing, but it's much better to have the experts talking to you directly. And we have all those people on the call today. While we're assembling, I did want to just sort of check in and kind of help talk through where we're at in all this and the role NHRC would like to play to be helpful to you. Understand it's a difficult and complicated time right now. We would like to be a resource for you and your organization, both kind of moral support and also really to give you the kind of tools you need to do your work most effectively. So with that goal, our last Leaders in Housing Counseling call was really aimed at a framework for how to do the transition to virtual offices. And we had 9 of the groups that are in different stages of this process talking about all the kinds of things like the technologies that are available, different platforms, what the best practices are, how to deal with cybersecurity, a whole range of issues like that. It's 2 hours long, and that we ended up having to record because the systems weren't able to handle it that well. The webinar got overwhelmed, and so that's a recording, but you can tap into it at any time, and you can get to it through our website just by going to the media library in our website. And so today is the second one in that series, and this is really addressing the issues of community about the issues of foreclosure and forbearance and loan modification with the largest providers in the field. And then we plan to do more going forward and would love your input about what's useful. Next week, one thing is we shifted to doing weekly calls rather than the usual twice a month, so that we will be a little bit more nimble and able to respond to what people's needs are and what the changing information in our world is. So we will be doing that for the foreseeable future. We'll switch back once things calm a little bit down, but we felt like we've got enough material coming in that it would be good to do these regularly. And you should also think about them as potentially being 2 hours long. So we don't want to do this unnecessarily. We know your time is valuable. But we also want to make sure that we get enough in-depth information out. And this particular session will be about, we'll leave the window open for 2 hours in order to make sure the questions get answered and as many issues get covered as possible. So other things that we're thinking about doing on sessions are the new on tenant issues and what the new eviction regime is like, so that we can get you the latest information on that. We know there's a lot of information coming, there's a big increase in rental calls coming into your offices and to some of your offices, and we'll plan to try to pull together some of the groups that are doing great counseling in the rental space and see if we can't do a session on that. So if that's a specialty of yours, please email us right now, and we would love to. We need to put together a panel on those issues in the next coming weeks that I think a lot of us aren't doing yet, and but if it's becoming a bigger part of our space, we want to be able to help prepare people for that. We're also going to do, and the new, we're going to do the new, how the new law has changed on evictions, so that you have some of the basic information. That will be our one of our next ones coming up. We'll do something on the new nonprofit forgivable loan program that came in with the Stimulus Act, and we're looking for informational people on that. So, and if you've got somebody who's an expert, let us know. We'd love to have that as part of our panel as well. And we're thinking about other kinds of issues, how to manage in a virtual world, what are the management issues, things that might be useful. But it'd be great if you'd let us know what you need and give us some guidance. We're pretty interested in trying to be as responsive as we can. And also, if you've got things that you think would be good to share for the broader community, we'd love to hear from you as well, so that we can piece together some of these into the programming that we do. We'll continue posting on the website on the listserv as things move forward, and we'll want to keep that information as fresh as we can. So keep an eye out for things as they come. We're working in Congress. We were not included in the housing counseling. Housing counseling was not included in any meaningful way in the stimulus bill that just passed. We are working with members of Congress and with House Financial Services Committee Chairwoman Maxine Waters with a proposal for $700 million for housing counseling funding. And hoping to make it as useful as possible. The idea would be that it would be not only for providing direct services, but also for the equipment and technology needs, the outreach that you have, and the training needs that you have. So that's a work in progress, and Melody and I will keep you informed on it. But it's at least encouraging, and we're part of the mix. We're also just interested in hearing what you're thinking about and what we can do to move forward on our work. And so please communicate with us about that. One more piece that we're working on right now is to rebuild the network of communication between counseling agencies and servicers, so that during the foreclosure crisis, some of you as long-term veterans may remember that there was a robust list of counselor hotlines that we could use to call into individual servicers to work on cases. There was the Hope Loan Port to share documents, and there was and then there were escalation points that were in place that allowed us to problem solve and take issues, work on cases that were basically having trouble getting through. We were able to move all those things forward, and a lot of it doesn't exist anymore. We have been reaching out to individual servicers to get them to reestablish these. And we're also trying to get a list of all the portals that they have for the public-facing intake. We would love for counselors to have that at their fingertips. Our understanding is that it's easiest for people to be able to raise their hand to get forbearance if they go through a portal, and we're trying to create a master list around that. And actually, our friends from Fannie and Freddie and FHA, if they can help us with that and help crack the whip on getting these together, that would be enormously useful right now. And as soon as we have something that's usable, we will certainly distribute it to the counseling groups. And the materials we put together on this would be ones that that we'd like to keep inside the counseling world, so that the portals, the public-facing portals, will be open to everybody, obviously, but everything else would be ones that just we use exclusively for counseling, so that that system doesn't get overwhelmed and it meets its rightful purpose. So I'm going to give a quick outline of what we're doing on today's agenda. We're pleased to have Brian Montgomery, the Assistant Secretary for Housing and FHA Commissioner. And we'll have also on FHA, we'll have Joe Gormley, who's the Deputy Assistant Secretary of Single Family Housing, and Dan Barry Carmen, who's the Associate Deputy Secretary for Housing Counseling, and he's the acting head of the Office of Housing Counseling. We are then going to pivot to Freddie Mac, and they're going to give an overview on the new on the conventional loan side, on forbearance and loan modification and foreclosure policies. And Fannie Mae will also present on this as well, and they will give us, I think, hopefully a good picture on this. And then finally, we're going to have Steve Sharp from the National Consumer Law Center, who is both a practicing attorney in Ohio, legal services, and counsel for NCLC, who will talk about the USDA loans and FHA and VA loans, how they fit in, and also thoughts about how we can advise what counselors can say to clients around some of these issues and help us deal with our messaging. So with that, so we're, I know some of our guests are juggling multiple schedules, and Brian Montgomery is dialing in now. So as soon as he gets in, we'll move to that. In terms of asking questions. Hi, Brian?
Yes, sorry if I just got on.
Excellent. Well, let's flip over to you. We already did the intros, so I'm glad to have you. Let me turn it over to you. I know you're busy right now, and we appreciate you being here.
Yes, thanks, Bruce. I'm sorry I'm late. I've had another call and another one right after this, and I do want to thank you for letting me join you today. And I'm also want to acknowledge my HUD colleagues, Dan Barry and Joe Gormley, who run Single Family. I know you all know Dan Barry. And again, Bruce, I want to thank you and your team at the National Housing Resource Center. I know you've been working to ensure agencies and their counselors have the information and resources they need to continue to operate. And again, I want to thank everyone on the line. I know all of you are on the ground, operating in our communities across the nation each and every day, answering the tough questions from consumers who are rightfully scared they may lose their home during this pandemic. It can be easy offering support while you too are experiencing the disruption. And I want you to know how much we value you and the work you're doing to help people at this vulnerable time. You are our partners on the front lines who are truly making a difference. We at HUD are doing everything possible to make this period less difficult for you and your agencies. We are currently reviewing all of our policies and procedures to identify items that might hinder your ability to serve clients. We will look at the certification deadline, current reporting requirements, and many other policies with an eye toward identifying what absolutely must be done and what is not possible to accomplish, given the great adversity many businesses are experiencing. You can expect we will adjust where possible. We want to provide you the maximum amount of flexibility during this time of national emergency. We want to empower you to continue to deliver quality services in your communities while adhering to the health and safety protocols that are being put in place. Despite the disruption caused by COVID-19, regular business continues. We are currently working on the comprehensive and training grant NOFAs and anticipate those funds will be released soon. As you may know, the 2020 appropriations allocated $3 million for the department's counselor certification efforts. The statute was drafted such that it caps certification-related expenses at $3 million, and we must ensure that cap is not exceeded. We are exploring now how best to implement these requirements without creating an administratively burdensome process for you and your agencies. We understand how important releasing these funds is to your operations and how much streamlining our policies can enhance your ability to serve clients during this challenging period. We are working hard to make it easier for you to offer the services consumers really need right now. And we know there's been a significant increase in call volume from Americans worried about how they will manage their mortgage payments over the next few months. They have many questions. Should I pay my mortgage? What happens if I do not? Or I can't reach my servicer, what should I do? Just anecdotally, servicers are telling us that their incoming call volume has gone from 70 to 80%. People who were inquiring about refinances a week or so ago, to now 70–80% of people inquiring about options if they are unable to make their payments. And with this morning's new unemployment numbers, you can bet that number will only increase. When it is possible, of course, we want everyone to continue to pay their mortgages. But for the many families who are now under pressure, those struggling to or who simply cannot make regularly scheduled payments, there are a host of options. We will do everything possible to keep them in their homes. Additional help, fortunately, has been provided in the form of the stimulus bill, with additional protections and time to work things out. As Secretary Carson has made clear, no one should lose their home on account of this virus. For anyone with an FHA loan, we declared a moratorium on foreclosures and evictions for 60 days. That stops the process where it is. In the case of foreclosures, it means they cannot be initiated. Fannie Mae and Freddie Mac have done the same. We'll obviously evaluate the length of that policy as needed in the weeks ahead. Borrowers who are now having difficulty making their payments should contact their servicer or lender as soon as possible to discuss the options, including forbearance. And please advise them not to delay, to call, to email, or try to contact the servicer on their website to discuss their possible options, again, including forbearance. Servicers are also transitioning to remote work and will experience continued delays along the way. From FHA, we have reminded FHA single-family servicers of their obligation to offer the full suite of FHA's loss mitigation options to distressed borrowers and to help prevent future foreclosures. When this national emergency was declared, FHA immediately issued temporary waivers related to the in-person contact as part of early default intervention. And last night, in accordance with the CARES Act, we swiftly issued a mortgagee letter with loss mitigation options for single-family borrowers affected by COVID-19. These loss mitigation home retention options are available to single-family borrowers, and they also extend deadlines from home equity conversion mortgage borrowers. To be clear, servicers must offer borrowers a forbearance if the borrower is experiencing a financial hardship as a result of COVID-19 for up to 6 months to start. That allowance may include one or more periods of reduced or suspended payments without specific terms of repayment. And if the borrower requests it, servicers must extend the forbearance for an additional 6 months. As long as the borrower is on a forbearance plan, the lender servicer must waive all late charges, fees, and penalties. We've also prioritized the use of so-called standalone partial claim for FHA insured loans, which was used extensively following the 2017 hurricanes. The COVID-19 national emergency standalone partial claim is designed to be used once a borrower's COVID-19 forbearance period ends. Together, these options allow borrowers facing financial hardship due to COVID-19 to stay in their homes and to hopefully bring their mortgage current in the future. For borrowers who do not qualify for the COVID-19 standalone partial claim at the end of their forbearance period, lenders are required to evaluate them for other loss mitigation options. I'll let Dan, Barry, and Joe address any specific questions regarding eligibility and documentation, but in short, borrowers who are delinquent as a result of COVID-19 are deemed to satisfy the eligibility requirements. The mortgagee must use the limited documentation outlined in the eligibility requirements for the standalone partial claim. So we believe we have a rather robust process in place. We're going to continue to evaluate the situation and the policy responses to ensure the health and safety of families and to ensure no one loses their home due to the outbreak. For single-family borrowers who are in the process of, or those who are still ready to purchase their home, we want to keep those transactions moving, and this is very important. Last week, FHFA directed the GSEs to temporarily expand the use of appraisal alternatives and to provide flexibility around employment verification, and we have done the same. I'll also mention many of the changes that we at FHA have made, both in policy and process, have been designed to increase access to FHA loans by ready, qualified borrowers. At the core of that effort is our ongoing modernization of FHA's IT infrastructure. We've been building the platform and have recently stood up for both the submission of claims and appraisals. And just this past week, we have reoriented our efforts to move swiftly to solve a problem that has been made worse by this crisis. And that problem is the antiquated use of paper case binders for HUD homeownership centers to evaluate and underwrite loans. We are now fast-tracking the use of our new platform for the electronic document delivery system for lenders who do not have delegated authority to endorse loans on our behalf. And there are 100 to 200,000 of these loans every year. And as you can imagine, that's a lot of paper. By tomorrow, and possibly even late today, we expect to be able to accept the large paper case binders electronically on this new platform. Our underwriters will be able to pull these down from home and complete endorsements remotely. It's been an all hands on deck, albeit virtually by our team, but we believe it will be an important step now and moving forward. Well, again, I want to thank you again for the opportunity to be with you, and thank you again for your tireless work and continued diligence in advising our clients, in particular at this time, helping many people who are understandably feeling very vulnerable during this period of enormous challenge. Please visit our housing counseling page at HUD.gov for links to COVID-19 policy changes, and also go to HUD's COVID-19 landing page, which is HUD.gov/coronavirus, which provides many useful links. Well, please have a good day. Please let us know what you're seeing and hearing out in the field that requires our additional attention and resources. And thank you again, Bruce, for including us.
Thank you, Brian. Appreciate you coming in. And for all those that have questions, so put them in the chat box, and Ellie Pepper is going to handle moderating the questions so that we can move forward. And Ellie, do we have questions already in the queue?
We sure do.
Oh.
So Joe, are you there? Joe Gormley?
I'm here.
All right. So we have Joe Gormley and Dan Barry Carmen, who are here to do their best to answer your questions. First question is, what programs are going to be available for people that just purchased a home less than 3 to 6 months ago?
So thanks, Ellie. So for FHA borrowers, the loss mitigation programs will work the same for all borrowers, no matter when they bought their home. Unfortunately, hello?
Joe?
No, Joe's here. Sorry.
Okay, that might have been Brian.
Somebody else hanging up. Yeah. So the loss mitigation programs will work the same for all FHA borrowers, no matter when you bought your home.
Okay. The next question, is there any thought to offering a forbearance or a deferment rather than a forbearance? There's just concern from some of the counselors about homeowners owing a big payment at the end of the forbearance time. And I know that there was talk about the partial claim, but
yeah. So maybe it's worth kind of unpacking that a little bit and explaining how the partial claim works and what other options the borrower could use. So the way the partial claim works is at the end of the forbearance period, let's just say for this example, the borrower is in forbearance for 6 months. And at the end of that time, the borrower indicates they can resume making their former mortgage payment. The servicer will execute what's called a partial claim, and they file that claim with FHA for the 6 months of arrearages. In return, the borrower agrees to what's called a subordinate lien, or some people sometimes call a soft second on their mortgage, which is only repayable basically when the mortgage terminates. So when the borrower sells the home, refinances, or pays off the mortgage, and that's an interest-free loan for the entire time that's sitting out there. Understanding that some borrowers may not want to do that, or may have the financial ability to quickly make up the arrearages, they should talk to their servicer about possibly entering into a repayment plan. If the borrower is unable to resume making their prior mortgage payment after their forbearance, then FHA's normal loss mitigation waterfall will apply, which includes the FHA HAMP option.
Thank you.
And can I just follow up a question on that? Just to, so when people are in forbearance, and then they go to, and then they get back on their feet, and they're ready to go into the final resolution, so it's partial claim. Are there any late fees? Are there any additional interest? Is there anything that becomes an extra burden on top of what they would have normally paid, but just deferring it for the 6 months?
Great question, Bruce. No, under the CARES Act, there are no late fees or penalties for the borrower for the forbearance period. And I should add, the CARES Act also prohibits servicers from reporting any negative credit information. So the fact that a borrower is in forbearance should not be reported to the credit reporting agencies.
Okay, there's a couple of questions around, knowing that this guidance just came out last night. There's just a couple of questions about how to deal with servicers who may not be allowing for a full 6-month forbearance.
So I would say if borrowers are experiencing difficulty, with their servicer, they can always reach out to FHA through our resource center or national servicing center. I think, we've had discussions with a lot of the larger servicers. They understand their responsibilities under the CARES Act and under the guidance FHA put out last night. But for other lenders, it may take a while for, the guidance to filter out. But I would just strongly recommend if a borrower is experiencing difficulty in getting the forbearance, that they contact FHA, or they can have their housing counselor contact FHA as well.
So then it should, if a homeowner is being offered a 3-month forbearance, then it sounds like they should push back and say, no, FHA says that it's a 6-month forbearance. Is that correct?
So to be clear, the CARES Act only applies to government-insured loans, so FHA, VA, USDA, and those owned by the GSEs, Fannie and Freddie. For loans held in portfolio, those lenders may be offering different types of forbearance. But if you have an FHA-insured loan, the borrower is entitled up to 6 months of forbearance just by making an attestation that they're experiencing a COVID-19 related financial hardship, and it's extendable for 6 months if the borrower affirms that the hardship continues.
Okay, so it sounds like you just answered this question, but I'll ask it just in case. There's not going to be a packet that will be required before they get the forbearance.
Correct. So under the CARES Act, there is no documentation required other than the borrower's attestation, which can be verbal, to the lender that they're experiencing a hardship.
Okay. A couple of people are asking questions about what if somebody has already used up their maximum amount of modifications that FHA will allow, or if they are within the 2-year time period between assistance applications.
So to answer I'll answer the second part of that question first. I believe, we'll have to check, but I believe the CARES Act forbearance supersedes that restriction, the 2-year restriction. But we'll have to, apologize, I just do not have the answer to whether or not they, if the borrower has already used up their lifetime, the other loss mitigation options. But we can get we can get information on that and get it to you all.
Yeah, you can get it to us and we'll send it out to everybody. Does this, are there any other loss mitigation programs for individuals that may have lost their job? Other than forbearance, any other loss mitigation?
So, yeah, I mean, they can have a borrower can have a discussion with their servicer about what other loss mitigation options are. I don't know what situation where there would be a better option than forbearance, but just not sure.
Okay. And then what if somebody is already in a trial payment plan, or they were already beginning to experience a delinquency and now it's going to get even worse? Are they eligible for this as well?
Yeah, so the The forbearance applies, that's available to anybody who was current or less than, or up to 30 days delinquent on, I think the day the national emergency was declared, which was March 13th, I believe. For individual situations, the borrower should certainly reach out to their servicer to understand what options might be available to them.
Okay, and does the forbearance also apply to non-owner occupied mortgages or just to owner occupied?
I'm going to have to, we'll get that to you.
Okay. So somebody asked about the credit reporting impact on those who have a forbearance. I think that you answered that question by saying that there is not a credit impact, correct?
Correct.
Okay. That's a question that was already asked. Somebody's asking about loss mitigation program available to a multi-unit dwelling. It's a rental property, which is similar to the question, but it's
so
not just a non-owner occupied.
There are options for multifamily. There are both options for multifamily owners and renters who live in FHA insured multifamily projects. Unfortunately, since I'm a single family dad, I have not focused on those, but we can connect you with somebody at FHA in the multifamily program who can offer more information on that. I should mention HUD on its website has a coronavirus page where we have a number of FAQ documents on single family, multifamily, public and Indian housing that probably answer many of these questions.
And just to follow up on that, so 2 to 4 unit properties, are they covered with the forbearance? Or are they considered single family?
So single family program is 1 to 4 units, and yes, any 2 to 4 would also fall in that category.
And we'd
owner
probably
occupied
encourage,
2 to 4.
and I'd like to just encourage FHA to consider providing that same forbearance for people who were maybe 60 days delinquent, but also impacted by the COVID-19 problems, because in fact they have the same problem, and they were already maybe had reduced hours or something like that, not for their fault. It would seem like it'd be helpful to be able to give them forbearance when it's appropriate. I encourage you to think about it. Okay.
Okay, so I have a comment and a question around partial claim, and the comment just is that it's been really difficult to get servicers to grant partial claims in the past, and that this counselor hopes that that changes. And the question to go along with that is, will the partial claim remove the limit of the 30% rule, as there are many people who already have had a partial claim?
So we think the partial claim, there will be a good uptake on partial claims with servicers. One, we're requiring it. Two, I think it's to their advantage, because the partial claim allows the servicer to get back the money that they advanced for the borrower's missed payments. So they're certainly incentivized to participate in the partial claim program. And the COVID-19 partial claim, I think like I said, some borrowers are going to have to talk to their servicer about what options are available for them. We can also look at putting some additional FAQs as different situations come up.
Okay. Somebody is just commenting and asking, are the lenders who participate in the FHA program ready for the potential increase in help? Since 2000 to 2010, it was pretty clear that they weren't ready for the influx of help that was required at that time. And this is likely to get worse.
Yeah, so I would say, from our anecdotal conversations with servicers, they're certainly seeing an increased volume of inquiries about people who want to know about their options should they be unable to make their mortgage. And I'm sure now that we're moving into April, and we're starting to see some additional job losses. People will, be asking for forbearance. And I think one of the things we need to stress is that, servicers are in the midst of taking their workforces remote too. So they're dealing with that. And I understand it may be frustrating for borrowers at some point, particularly if they're trying to make telephone contact. I think a lot of servicers at this point are suggesting you should try to contact via email if you have that capability. And they're also setting up online portals for borrowers to to schedule a time for a call rather than sit on hold for, a long period of time.
Okay, and
while you're on that question, if I could just, if there's somebody at FHA that is collecting that information, we would like to get it to counselors so that they have one place where they can look at the intake portals, the call-in numbers for the public. Now, we'd like them to be specific ones, especially for counselors as well, but even getting that basic information, nobody seems to have assembled it. So I don't know if that's
sure. So that single destination does not yet exist, but it's something we're discussing internally. I think it could be very useful to counselors and borrowers in making contact and best kind of practices for making contact with their servicer.
Okay.
So there's just a few people who have commented that their servicer, the homeowner that they're working with has been in contact with their servicer. The homeowner has an FHA mortgage, and one person said their client had been told that the investor wouldn't allow the FHA forbearance. And then again, many people are commenting that when borrowers have called their FHA lender recently, that they are hearing that the 3 to 6 month forbearance is not being offered.
So
I think the biggest question would be to discuss the investor issue.
So the investor has no bearing on any decisions about the forbearance. The forbearance is required by the CARES Act, and the investor really has no part to play in that. And I'm sorry, I had time for one more question, but then I have to jump on a 2 o'clock call.
Yes.
Okay. Do you have a program in place requiring that servicers reach out to potential borrowers to be informed about the help available, maybe through the state housing agencies? That this person is saying that they're still experiencing borrowers afraid to contact their servicer, and may not know about the available forbearance.
So there is no requirement that servicers make contact with borrowers. I know a lot of servicers are being proactive and putting out information due to the COVID-19 emergency. HUD also on its website has a consumer-facing FAQ about the forbearance and standalone partial claim that we put out last night on the mortgagee letter.
Well, thank you.
Good.
There are many more
Thank
questions, and can we send you some questions that maybe come up that didn't get answered, we weren't able to get to today?
Absolutely.
Great.
You guys have my email address, so yeah, send them our way, and we'd be happy to take a look at them.
Perfect. Thank you.
Excellent.
Thanks so much.
Thank you so much. Great.
All right.
Thank you, Danbury. So we're
so can
really,
I, before we move on, since we do have Danbury on the call, I do have to say that there have been a couple of questions that have asked about an extension on the certification. And Danbury, you have yourself muted. If you're trying to speak, you've muted yourself.
Yeah.
Oh, there you go.
Thank you, Ellie and Bruce. I do have to be on the same call with Joe, but Terry Carr is on, and Terry can certainly answer all of your questions. And please include Terry and I on your emails to Joe so we can help with getting answers for you.
Definitely.
Okay, thank you.
We'll be glad.
Thank you, everyone.
So Terry.
Yes.
So you get to answer that question.
I guess I do. I'm going to reference the comments that the commissioner made, which he said, and he is correct. We are looking at all of our policies, and we certainly understand the disruption and the challenges that are posed right now. We are very aware that testing centers are closing and that it is probably nearly impossible to train or to take the test. So with all of that in mind, because we can't obviously comment on any changes in our regulation, I would just say that we are looking at it and we are certainly going to adjust where we think that is possible and appropriate. So so that's my response.
Thank you.
Thank you.
And of course, we submitted a letter to HUD a few weeks ago with a number of you had signed, making that request a while ago, but eager to hear the response.
Yeah, absolutely. And that will certainly be factored into our decision.
Good. Ellie, any more HUD-specific questions that we need to ask, or should we move on to Fannie and Freddie?
We can move on. I mean, there are very many questions, but I would say move forward.
Okay, good. Okay, well, excellent. So let's pivot to.
I'm going to go unless you guys want me to stay. I'm going to go ahead and join this other call as well. Does that make sense?
That would be fine.
That makes sense. Thank you, Terry.
Okay, thank you.
Thanks,
right.
Terry, as always.
Bye.
Good. Okay, so we're going to go to Freddie Mac and Fannie Mae and talk about these issues in the perspective of conventional mortgages. So let's start out with Freddie Mac. We've got Benjamin Gottheim. He's the Director of Mortgage Servicing Policy for Single Family Servicing. Ben.
All right, thank you guys so much. And just, in this age of us all remote working and using our technology, I just want to confirm you guys can hear me.
Yes.
We can hear you loud and clear.
Okay. It's amazing how great our technology is, but it's amazing how sometimes you just drop for no reason. So thank you guys. Thank everyone for for us being here. So I'm going first, but I know my counterparts, Eric and Rob from Fannie Mae, are going to follow right after me, and I think we've kind of decided to split up the topics a little bit because when it comes to Freddie Mac and Fannie Mae, especially in times like this, but overall, we generally do most of our servicing programs and requirements under GSE alignment as directed by FHFA and their power as conservators. So, I don't know if there's anything one of us is going to say other than the other as it relates to, our policies in this space. So that's the first thing I'll say. The second thing is, if you are reading our respective bulletins or lender letters today, you will note that we have put out a few each. We have put out information as it relates to servicing mortgages impacted by COVID-19. You'll notice that none of them have come out since the CARES Act passed last Friday, and we are furiously working as we speak to get that out as soon as possible. Again, alignment processes can take a little bit of time, and there are some, frankly, there's some legitimate, heavy issues in terms of interpretation of the CARES Act that, I'll talk about some of the topics and they can as well. So the topics that I'll address, kind of you think about what we put out there have been changes to our forbearance policy, our, credit reporting, the post-forbearance or loan modifications, and the foreclosure moratorium. So I'm going to take the first half of those, which is the forbearance and the credit reporting piece. And what we've done so far is put out what more or less amounts to our disaster policy. We have a set of policies in our guides that get triggered every time there's a FEMA declared major disaster with individual assistance programs. They're there specifically for the needs of the disasters. And what we did is we leveraged initially, again, this is pre-CARES Act, we pretty much leveraged those programs verbatimly. If verbatimly is a word, I don't think it is, but we leverage them as close as we can with one notable exception, which is the ability to offer a forbearance plan without any borrower contact, or what we call QRPC, Quality Right Party Contact. That's something that we have specifically for localized disasters because, as we've seen in situations in the past like Katrina and Sandy and Harvey and others, Maria is a great, most recent example. Communication lines are down. People cannot contact their borrowers. Borrowers cannot contact their servicers. And therefore, when a loan was current and now becomes delinquent out of nowhere, we allow servicers to make that that exception determination, and they can do that. That's not appropriate here. We need to talk with the borrower, right? We're not asking for any documentation or anything like that. Servicers can still, as is normally the case, approve a forbearance with no documentation, just a verbal conversation. But that verbal conversation or through other media like an app or a website is still needed. And frankly, from the feedback that we've seen from a number of you, as well as all other areas, including the media over the last couple of weeks, that conversation is in fact absolutely necessary because there's a lot of misinformation out there in a lot of different ways. With the first thing that I'll point out is forbearance obviously is not forgiveness. Now I know I'm not saying anything on this call with you all that we don't know, but outside of our industry, people don't necessarily understand that. Public people have made commentary about how payments would be waived or would be deferred, or a number of different words that all mean forbearance, or what we call forbearance. So those conversations are absolutely critical for borrowers' understanding, because the last thing any of us want is somebody entering into an agreement or doing something without the full breadth of knowledge of what it means and what the impacts are. So in terms of forbearance, what is our normal policy? So for Freddie Mac and Fannie Mae, our normal policy, just everyday servicing would be a borrower is eligible for forbearance if the property is owner occupied, for initially up to 6 months, and for a total of up to 12 months of delinquency. That is our normal policy. It is always there. It's been there for a couple of years in that exact way. So a borrower is always eligible for those forbearance, programmatic requirements. What we initially did was announce that we have expanded, like we do in disasters, the forbearance applicability to all property types, including investment properties and second homes. And yes, Bruce, the question I think you had earlier is 2 to 4 considered single family. Yes, it is for us. And those are also eligible for our forbearance with the exact same terms. Now, as it relates to the CARES Act, which is what we're working on now, I think one of the biggest questions is the length of forbearance and in some ways the law is very simple, and that's good. In other ways, it is extremely hard to infer exactly what is required, and that's something that we're dealing with right now. In that it says pretty clearly the borrower is eligible for an initial forbearance up to 180 days, and they're eligible for a subsequent forbearance of up to 180 days. And obviously that breakdown is, I think, primarily related to RESPA servicing rules about forbearance and short-term hardship programs not based on a complete response package. So that's what it is, and obviously it just requires the attestation, or what we would call, again, QRPC on our side. So that's led to a lot of questions. Is it an automatic 6-month forbearance? What about somebody who's already more than a year delinquent? Can they now get forbearance where they couldn't before under Freddie Mac's guidance? And that's something that we're looking at. So again, I said earlier, our standard forbearance policy says that delinquent borrowers absolutely can get forbearance, but only up to a year's worth of delinquency. Meaning somebody more than a year delinquent or in foreclosure beyond that is not going to be eligible for forbearance at that point. So I think the universal understanding is that line in the sand, that 12-month delinquency line in the sand, is gone under this act, right? So it would be any borrower could be eligible for forbearance. I mean, so if somebody hasn't made a payment in 4 years, and in some of these longer foreclosure timeline states, they are now eligible for forbearance. I think that's probably pretty clear. The rest of it, though, is a little bit more complex. And I'll tell you some of the questions that we've gotten, which is, do we have to, does the initial forbearance have to be 180 days? So I think the language says it is up to 180 days. So, if you go straight to 6 months, that's perfectly fine. Frankly, that's what our policy has always been. If it is something less, that's fine too. I think one of the major, I don't want to say flaws, but one of the major issues with the forbearance language in the law is that it contemplates 2 forbearance periods and only 2 forbearance periods. And for us at Freddie Mac and again for Fannie Mae, it's the totality of the forbearance. The forbearance can be up to 12 months. Again, it's broken out because of no more than 6 months initially because of the CFPB, Reg X rules. But it's a total of 12 months. So is it possible that a borrower could get 4 separate 90-day forbearances and be in compliance with our guide? Absolutely. And in some cases that may be the best. That may be the best scenario. In some other cases, it may not. And we do not plan to prescribe that forbearance, no matter what the borrower asks for, must go out to 180 days. In turn, again, having those conversations and understanding the facts will help the borrower determine what level of forbearance that they need. And what we want to make sure once we put out this guidance that servicers understand is that regardless of the length of the forbearance, it should be extended if the borrower needs it. And the borrower can make the determination that it can go out to 180 days. So we want to make that very clear. But a lot of borrowers, the feedback that we've gotten, again, number have called in and have asked for, I want a forbearance. They believe it's actually forgiveness. Once they're told, no, you will have to pay these back. You will have to pay the money back in some way, shape, or form at some point. A lot of people, will state, I can make my payment today. I don't need this. Thank you. Some people will want it only for a short term because, again, they understand that it's going to, they are going to have to pay it back. And the more forbearance you take, the more you're going to have to pay back later. And that's, so everyone can have that decision. What we want to make sure is that everyone gets the forbearance up to a full year if they need it. And how that's done is really going to be up to the borrower and the servicer working together. But again, within the confines of that law, which says that the borrower can request up to 180 days initially and 180 days subsequently. But we don't want to limit it to only 2 forbearance periods because in the event a borrower asks for 90 days and then asks for another 90 days, we don't want them to tell them, sorry, you asked wrong. You still can get up to 12 months of forbearance, and that's very important. The other piece that is we're finding is a big confusion topic today is the concept of forbearance versus deferral or versus deferment. And we also know that some of this is because of the timing of our announcement causing a little bit of confusion. I think many of you know that we announced last Wednesday a new payment deferral product, which is a short-term hardship solution for somebody who is a rolling 30 or 60-day delinquency to defer those additional, but is not able to reinstate through traditional means or a repayment plan, that we will defer those previously missed payments into a non-interest-bearing balloon at the end of the mortgage. That program is not a response to COVID-19. That is something that the GSEs have been working on for a very long time and has been planned to be delivered, all along and announced in March. And the reason we didn't pull it or delay it is because there are some borrowers this program in its current state may help, and we wanted to get that out there. But we understand that it's created some confusion in that, there are a lot of people who are coming and asking for a deferral. They're not asking for forbearance, they're asking for a deferral. And it's creating confusion because they are 2 separate things. A deferral is a permanent move for the monies to go to the back end of the mortgage. A forbearance is a temporary stoppage, either suspension or reduction of payments. A forbearance is the right solution for somebody who can't make a payment. A payment deferral is the right solution for somebody who's a rolling 30 or 60-day delinquent loan that can make the payments but can't reinstate the full balance. There's a big difference there. And that's creating a lot of confusion in the market right now. I think you guys know historically we have always talked about, we want servicers to engage with borrowers about what the loss mitigation type solutions are going to be after the forbearance period is over. And I know my partners from Fannie Mae are going to talk about that pretty shortly. And we want them to have those conversations, but our stance has and will always continue to be, you don't put somebody in a long-term solution before you know what they need. And that's why forbearance is so appropriate and so important, because forbearance ensures there's not going to be any type of foreclosure action. There's not going to be any late fees. Under our current rules, it has credit reporting consideration. We'll talk about that in a second. But it's very important, that the borrower gets into the forbearance plan, and then when they are ready to start repaying, in whatever way that is, that we address it at that time. We don't want to tell somebody you're eligible for a 3-month extend mod today, when they may need 6 months of forbearance beforehand, and then we have to go through the process again. So it's very important that those conversations are happening. It's very important that we get somebody into a forbearance, and that we are working as an active community to make sure that borrowers understand the difference between a forbearance, that is a stoppage or a reduction in payments each month while the borrower can't make their payments, versus a permanent solution like a loan mod or payment deferral. The other part that I'm sure my colleagues at Fannie will touch on as well, but that I'll bring up to end the forbearance discussion is, one of the things that we're hearing is, in no way, shape, or form is the borrower required to reinstate the mortgage balance, the past due balance, at the completion of the forbearance. It is the first thing in our loss mitigation hierarchy. If the borrower can afford to reinstate, they should. It's obviously the best thing for them, not having to engage in a loan modification or something to that effect. But most of these borrowers are not going to be able to do that, and that's fine. And we have loss mitigation solutions that will be right for them. That again, my colleagues at Fannie will talk about shortly. But I want to be very clear.
Clarify, Ben, yeah. So what you're saying there is, on the forbearance, so somebody has 6 months of forbearance. When you're talking about reinstatement, that means that you not only make your mortgage payment, but you also your regular mortgage payment, but you also pay off the balance of what was owed entering the forbearance period. And so what you were messaging there is that that's not the expectation. That's not what's going to happen. You have other tools for that. Is that correct?
That's absolutely correct. That's absolutely correct. If a borrower can do it, and we've been talking a lot over the last month about COVID-19 versus what we call disasters, a natural disaster. They're not the same. And a great example is that after a disaster, most borrowers will reinstate. They won't do a loan modification. They'll actually reinstate. It's a different scenario. There's an insurance check involved. It's property damage. It's not employment damage. It's not illness. It's not what we're facing right now, where we're all working from home. It's a very different scenario, and borrowers will by and large reinstate. That's probably not going to be the case here, and that's perfectly fine. And if somebody can, that's great. And if they can't, we have repayment. We have loss mitigation, workout modification options. So I just want to make sure that that's very clear. Yes. That is at the top of the hierarchy, because it's the best thing if somebody can reinstate, but it's certainly not the only thing that we can do. And again, I talked about loan mods, but obviously liquidations as well if the borrower chooses that they can no longer afford or don't want to live in that property anymore. So that's forbearance, and I'll briefly touch on credit reporting as well. So we have a kind of longstanding policy in the disaster space that we have always said that if a borrower is on a disaster-related forbearance or payment plan or trial period plan, that the servicer must suspend credit reporting, which means don't report anything. Or so I think we actually say suppress credit reporting during that period, and only for those borrowers. This has been a very controversial policy that we've had for a long time. I've been at Freddie Mac now for just about 10 years, and I believe the policy predates me. And it's always been controversial because it's very unclear whether that requirement is within the bounds of the law, within the bounds of the Fair Credit Reporting Act. And it's something that we have looked at before, but again, this has been our existing policy. It's what we put out for COVID-19 as well. And yes, it still remained controversial until a week ago when the CARES Act passed. And yes, again, we do know we need to update our guidance, and that will all be forthcoming pretty soon. But the CARES Act does have its own actual changes to the FCRA that are specific to how to report borrowers who are impacted by COVID-19. I think the way I'd summarize it is, if you were current prior to the National Emergency Declaration and now you are not, it's suppression. If you were previously delinquent, it's delinquency. Whether you're on forbearance, whether you're on a repayment plan or a trial plan is irrelevant to that conversation. So, what are we going to do about it? Again, I'm not 100% sure because if our guidance isn't out there, hopefully pretty soon, but I think we'll just defer to the law because this has been a longstanding issue with us of always having guidance that may not be in concert with the law. And, just as a reminder, the law is always supersedes what we put in our policy. We at Freddie Mac don't make law. So if federal law like the CARES Act supersedes our policy. So while we're waiting to get our guidance out there, the topics about forbearance and about credit reporting that I've already said are already what servicers have to do because it's required by the law. We're going to update our guidance to make sure that we're crystal clear that our guide is now in concert with what the law is, and anything that's on top of it that we want servicers to do. Again, one major thing is reminding them that they can offer up to the full 12 months of forbearance, even if it's more than two individual forbearance, two individual back-to-back forbearance plans, because of what the borrower has requested. Okay, I think I spoke a lot of information, and that's only half of what we have. So I think that's the time that I'll stop, and then I believe, am I passing it to Eric at Fannie Mae?
To Rob Raymer.
To Rob, perfect. And then
Thanks,
actually,
Dan.
guys, just real quick, before, I'm sorry, I forgot my notes of what I'm supposed to plug, which is you can always go to FreddieMac.com to get information. We have a specific COVID-19 page with FAQs that are being updated daily as well. And I just want to make sure that information got out there. Thanks. All right. Thanks, Rob.
All right. Thanks, Ben. I appreciate that. It was good information, and I appreciate you, all the information that you were talking about, especially about the forbearance and credit reporting. Well, let's go ahead and get this thing started. My name is Rob Raymer with Fannie Mae, work with the community lending team. I just wanted to kind of piggyback off of what Ben was talking about, really talking about understanding and really understanding the hardship and how it affects the borrower. In doing that, this is a horrific situation that we're all under, and we have to probe. And that's probably the key word here. What I'm going to be talking about is probing to really identify the impact and how it does impact as it relates to the specific circumstances for each borrower. For those impacted by COVID-19, you could be looking at business closures, or you could be directly impacted due to the fact that medical expenses, you could have a family member that is affected. The impact could be felt really, just beyond that. Identifying with the from the borrower that is responsible for the mortgage, but it could be a spouse, family member, or anybody that's actually contributing to the monthly obligations. And this is very important to determine how they have been impacted. So, and whenever you're looking at that, it's really as it relates to this, you need to determine long-term versus short-term. I mean, on the surface, you think about, COVID-19. Well, yeah, it's going to be a long-term situation. Has it been resolved? No, it hasn't been resolved. But in some cases, that's where the probing comes in. You have to ask these questions. So, explain to the homeowners the importance of the fact that, we need to get this information so we can determine what really is the best solution for you. And to reiterate some of the stuff that Ben was talking about earlier, is that you have some of these borrowers that come back to you asking, hey, I need this modification. I need this deferral program. Again, we have to be able to talk to them more about what is truly happening with them. So, with COVID-19, we still don't really have a good idea as to how long that these particular people are going to be impacted. So determining the hardship, whether it's a long-term or short-term, is a key identifier in what we really need to find out about what's happening. So, you think about it as an example. You have a homeowner that has no income. They ask for a modification. All we're doing at that point, if let's just say that we actually did that, we'd be setting them up for failure because they really don't have the ability to make that payment if they are impacted by the fact they could be unemployed. So that's where we're talking about pairing up the right solution for that particular borrower. So to move on along here, I was going to kind of talk a little bit about the payment deferral program, but I'm going to kind of reiterate just a little bit about what Ben said. Again, you have to understand, and please make sure that your borrowers that you're talking to understand this, is that this solution is not going to be available until July 1st, and it wasn't created to address the issue of COVID-19. So again, I'm going to talk about it more at a higher level scenario, but I mean, that's really the biggest takeaway that I want you to think about when it comes to the deferral program, is that it is out there. It was a coincidence that it was made public to everybody at the same time. But again, it is not meant to address the COVID-19 crisis that we're dealing with right now. So the next solution effectively in order to deal with the situation is that after you get through the forbearance period, then we look at a program called the Extend Mod. And the Extend modification, essentially what it does, it allows a homeowner to extend the term of the loan by the number of payments missed. So effectively, if you have a customer that still owes 20 years on the 30-year loan, and they have a 6-month past due delinquency out there, effectively what this is doing is making that loan have 6 months more tacked on to the end of the term. So you have a 20-year term currently, and after you go through the extend modification, you're looking at 20 years plus 6 months. Effectively, 246 months is what would be available out there. The homeowner is going to need to repay any kind of the missed escrow payments over the period of time, and it can be actually spread out over a 5-year period. In this particular solution, the interest rate would stay the same, and if the homeowner actually had a fixed rate loan. One thing to be clear about here, excuse me, the borrower response package is not required for this particular solution, but the servicer has to establish the right party contact, the quality right party contact. The reason being here is that we have to confirm that their current payment, because what we're doing, we're telling them you can still make your current payment. We have to establish that the current payment is still affordable to them and they still have the ability to make it. So the next solution out there would be the cap and extend modification. And essentially this allows a borrower to capitalize the delinquency into the mortgage balance and extending the term to essentially keep the same payment. So with this mod, the interest rate would stay the same if the borrower had a fixed rate loan, and the borrower response package, again, is not required for this particular solution. A lot of people, start thinking, okay, well, what's the difference between the extend mod and the cap and extend mod? The big difference here is that the extend mod, we're actually just extending the term, where the cap and extend is where we're capitalizing the losses. We're actually rolling it into the mortgage balance, and we're just extending out the term to effectively keep the same level of payment. But again, the right party contact is very, very key here, because we have to confirm that the payment is in fact affordable to the borrower.
And then explain a little bit about, Rob, could you just explain what the trigger is between extend and cap and extend, how Fannie decides or Freddie decides which one applies?
Eric, you want to chime in on here? Or?
Yeah, I think it's dependent on the case, on what the borrower can afford. So the extend is most likely going to be in a scenario where I would think in cases where it's fewer payments. So for example, if we're tacking on 1 or 2 payments on the end of the loan, it's really not that big of an impact. But let's think about, say this, what Ben had spoken to was the 12-month forbearance. Let's say you were on forbearance for 12 months. You got 12 months of payments that have to be capitalized. Well, then we're talking about a much more significant impact. And if you can actually capitalize those delinquent payments into the balance of the mod and then extend the term, and every month that you extend the term by, you're actually reducing that payment back until it gets to the original amount. So I think your case will be better for the more severe the delinquency. The more likely the cap and extend would be a better option. But the good thing about, and I can't speak to, Ben, I can't speak to the technology that you have on your side, but within SMDU, Fannie Mae's system of that servicers will go into to submit the case, it'll do that calculation for you. It'll put, or for the servicer, it'll put that calculation together and say, this is the best option given the circumstances, given this delinquency, and so forth. I hope that helps.
I appreciate that, Eric.
Hey, Eric and Rob, it's Ben from Freddie. Just real quick, I think you're goading me into saying that workout prospector cannot do that, and that's just the truth of the matter. We are obviously, I think many people know, working on a new loss mitigation solution, which is of course impacted by this virus. So for us at Freddie, I think you guys are absolutely right. The only thing I'd add in when we talk to servicers, if kind of how do you break down basically whether it's extend or cap and extend? What we find is that if the borrower has, if the servicer has had to make taxes, insurance, or HOA, whatever advances on behalf of the borrower, the cap and extend is a more affordable solution. If they haven't had to, the extend mod is more affordable because there's no capitalization. So, exactly. to your point, the longer the delinquency, the more likely the cap and extend is going to be the better solution, as long as you can afford that regularly scheduled payment.
Exactly. Good point, Ben. Thanks. Okay, so was there any other questions before I keep going?
Oh, go ahead. Yeah.
Okay. Well, so let's just say at this point, the borrower comes back to you saying, you know what, I can't make this payment. I mean, I'd love to, but I can't. We still have other options out there. So at that point, we would have to basically evaluate them for the flex modification. And in this case, basically, essentially what happens is it allows the homeowner to capitalize the delinquency. We basically roll it into the loan amount, and we extend out the term to 40 years or 480 months. Some people like 40, some people like 480, depending on what you think sounds better. But again, by doing that, it's going to lower the payment more than what the cap and extend or the extend mod would be doing. The interest rate would essentially stay the same if you had a fixed rate loan, and the borrower response package must be completed if the mortgage loan, if the actual delinquency is less than 90 days. If it's more than 90 days, then a borrower response package would not be required. But again, like I said earlier, is that this is going to give the homeowner the best chance at a lowered payment. And again, that's one thing that we're trying to look at. If the borrower has the ability to make his current payment, FlexMod might not be the answer for them. You might want to look at a cap and extend or an extend mod. But if they are truly struggling and they're thinking, okay, I don't think I can be able to make this payment going forward, it could be a scenario where they still are employed, but they've been told that their income is going to be cut by a third. Well, that's a huge impact to somebody that has monthly obligations. So they go, I can't make this payment the way it is right now. This gives them the ability to lower that payment. It gives them the best option to be able to lower that payment. Very key thing to look at. And the last thing I really want to kind of get into, because I'm kind of winding things down, I wanted to leave enough time for any kind of question and answer stuff. There are some other resources out there. And the one thing I can tell you, something that piggyback a little bit off of what Ben was saying earlier, is that there's continuous lender letters that are being published out there. Be on the lookout for the next one, because we do have to respond to the CARES Act. So we have to basically be aligned in that area. So pay attention to those lenders letters. But the other thing too, we have a website out there called knowyouroptions.com. It's being updated daily. There's a lot of information regarding the options that are available to stay in your home. If they basically say, hey, that's just something that is not for me, we do have other options for them out there. The big deal here is that we're trying to help these people, you know, and I don't even want to even go into the word foreclosure, but we're looking for them to help them avoid foreclosure. So this is something that we don't want them to have to go through. And the other website out there is obviously fanniemae.com. We have a lot of up-to-date information. We continue to update it daily as to what's going on with this particular crisis. So with that being said, that was pretty much everything I was going to be talking about today. I wanted to kind of leave, like I said, leave enough time for any kind of question and answer out there. So I will turn it back over to you.
Okay, Ellie, have we got questions in the queue?
Oh, yes, sir. So quite a few people just asked about different questions about documentation. So if one or both of you could kind of just talk a little bit about documentation required to prove your COVID-19 hardship.
So Ellie, I'm gonna, if you don't mind, because I think a lot of these questions are actually going to probably go to basically both of us. So I mean, I don't know if I really want to say it's definitely a Fannie question or a Freddie question. So I want to leave it open to all three, if that's okay.
Absolutely.
Okay. Yeah, absolutely. Yeah, whoever wants to answer. There's nobody on from HUD. So it's the three, right? It's the three of you. Whoever wants to take these questions, go for it.
Yeah, I think that we can address the borrower response package question. Is so for a forbearance, for the modifications, there is not a borrower response package for the forbearance. There is a requirement for the forbearance. There is not, you don't have to get documentation like a doctor's note, let's say, to say COVID-19. What you do have to do, the only requirement is you have to, a servicer has to make that right party contact to confirm that, yes, this is in fact the case. What we don't want to do, because it's a little different than, say, the disaster, forbearances. You know, when the hurricane came a few years ago, the hurricane season, we knew where Harvey hit. We had zip codes. We could find out where those properties were located and where the FEMA declared disaster areas were. So we can be proactive in that approach. But with COVID, we have no idea. And so that's the important part, is that QRPC. But they should not have to do documentation for that forbearance. For the modifications, once you're outside of the forbearance period, you want to get a modification. Depending on your delinquency, that's what would establish the borrower package. So if greater than 90, that's the borrower package would not be required. If under 90, then a package would be required. So I hope that helps address that question.
Okay. Will interest accrue during the forbearance period?
Interest. I can take that.
Oh, go ahead.
Sorry. No, yeah, we're going to talk over each other a few times. So, sorry. Yeah. So yes, it will. So interest will continue to accrue, and that's the purpose of these modification programs. But there will be no late charges or any new charges or additional interest. Just as with anything else, the contractual payments that are being missed are still due. So technically, that is interest being accrued during that period.
So then, right along those same lines, somebody else asked about how escrow will be handled during the forbearance period, and then afterwards, of course, when it's reinstated.
I can do that too. So that's, again, we talked about borrowers having contact with the servicer. That's a very important thing here, because we want to have that information, especially if the loan is being escrowed, right? If it's not being escrowed, it's the borrower is really making that determination whether they're still paying it. If they are not able to pay their mortgage, they need to have that conversation of whether that generally means the escrow payments aren't going to come in either, which means that conversation has to happen of, are you going to continue to pay those separately or not? And then if they become due, and the borrower has not made the payments, the servicer is required under our guide to advance those payments to the insurance or the taxing authority on behalf of the borrower. And then what happens to them after is they'll get added into the balance. So I think the conversation a few minutes ago that Rob and Eric had around the difference between the extended cap and extended is a perfect example of the impact of whether escrow payments aren't made during it and what the appropriate solution is. While all solutions are available to all the borrowers, the difference in appropriateness is going to be determined by a lot of factors, including whether the loan is escrowed and whether the escrow payments were made.
Okay, what if somebody is already late and it's, there's been different levels of lateness, so as little as 30 days to as long as 2 years. Just in general, what happens if somebody's already late and they want to try to get the forbearance?
Yeah, that's the question. Ben, you spoke to that previously. And a lot of that comes down to the determination with the CARES Act for those that beyond 12 months period is the big question mark here. You've got that date, and I think the HUD representative mentioned the date that the emergency declaration came out. That was March 13th. And so your question is probably for those that were delinquent prior to March, for those borrowers.
Yeah, that is the
those
question.
Borrowers. Yep. Those borrowers can be considered for workouts. They can be considered for a possible modification, for a possible forbearance. The question would be around, the credit protection that would be offered for borrowers that are current, that have the COVID hardship. And so that's what we need to determine, and as as Ben alluded to, is we got to figure out what our response is, from a Freddie Fannie standpoint. In alignment with that is, what does the credit protection look like for those borrowers? So I think that's kind of the big piece. We can move forward with considering any borrower that was delinquent prior to this for a modification. The concern that we have, and Rob mentioned it earlier, is understanding the hardship. So they probably had a hardship unrelated to COVID before this, whether it be unemployment, whether it be illness, whatever that could be. But now there's a very good chance they have COVID on top of it as a hardship. And so figuring out what that is and what that looks like. One of the things that we didn't speak to in the presentation is the moratorium around foreclosures. The good benefit of that is for those borrowers. You mentioned somebody that say they're 2 years past due and could be up against a foreclosure sale. Well, this gives them the chance to get back on their feet while that moratorium is in place, get back on their feet. If ultimately they're not able to get a forbearance, we still wouldn't be able to, they don't have the risk of that foreclosure sale occurring. And so they have the ability to get back on their feet, and then maybe it's a modification they can look for. Maybe it's another workout option they can do to avoid that foreclosure process.
So
does that,
just to understand this better, let me answer that. Let me ask that a little bit more, or to just push back on it. So the idea, so somebody is a couple months late before the crisis. So will they be able to get the 12-month forbearance? Let's not talk about the credit report issue right now, but just the 12-month forbearance, the 2 6-month forbearance. Is that available to them?
And Ben, I think that's the question, right? Is the 12 months? They can get a forbearance. We can put them on a forbearance. I can't say right now with 100% surety that it would be for up to the 12 months. Does that make sense?
I'll put my potential foot in mouth. Because I think you guys have figured out that we're not lawyers, so we can't provide legal guidance. We're not lawyers even for our own companies, let alone anybody else, to provide legal guidance on what the law says. Like I said, I can state the law does not have a delinquency cap requirement like our existing forbearance policy does. And we will make guidance soon certainly within the next week, that will address it. And I believe, given that the law doesn't have a delinquency cap, we're not going to either. So to your point, I'll go out on the limb and say, yes, they're eligible for up to a year, even if they were delinquent prior to.
Then the only difference, if that's the case, then the only difference is that they might still get negative credit reporting.
That's back to the interpretation, legal interpretation. Yeah.
Yeah, and just again, I want to make sure that we're really clear. We talked about credit reporting earlier, talked about our existing guidances, has always been kind of in this weird, kind of awkward place. It's in that awkward place because we, the GSEs, have absolutely no impact on credit. We don't govern it. We don't oversee it. We have nothing. The law doesn't even apply to it. Like, we have nothing to do with it. We've just had this long outstanding requirement about credit suppression that, frankly, I don't know that it necessarily provides the benefit that we think it has. We hope it has. We're not sure. Because the credit reporting is governed by other agencies and other oversight and different laws that are applicable to those companies. We're not experts in it by any stretch of the imagination. So that's why I think where we'll come out of all of this is to just defer to the law, because we don't know. We just don't know enough, and the GSEs can't provide the guidance in that space, given our that's not where our specialty or our knowledge lies.
Good. Let's pivot back to other questions.
Okay. So just kind of a clarification question. Are there since there are seasoning requirements for the MOD program, you got to have at least 4 payments and the loan being a year old, are those being waived for the, this might have been, maybe this is a question from FHA. Yeah,
no,
I think that's from.
I think it's a valid question for us. It would apply to us as well.
Go ahead.
And yeah,
Go ahead.
So currently Fannie Mae guidance is for the Flex Mod, for example, requires a 12-month seasoning of the loan. And what we're seeing right now is, and I'm sure, Ben, I'm sure you're getting the same calls from your side as well, is, we had these really good borrowers that were getting loans, high credit scores, good income situations, and just the sheer fluke nature of what's happening to them. They're now, we're looking at first, second payment defaults that are calling up and saying, I had a really good job. I just got this mortgage. I'm defaulting. So we're talking about a lot of borrowers that are really nervous right now that just got this loan. And so, for example, FlexMod, we are able to allow that to go through to bypass that seasoning requirement based on this hardship rule.
Okay, so while we're talking about FlexMod, then, so one question is related directly to the COVID-19 forbearance. In the FlexMod, there's an equity calculation. So the first part of the question is, will there be any equity calculation in the COVID-19 forbearance? And the second part of the question is then, after the forbearance period is done and people are considering different modifications, will the equity modification still be part of the equation for the FlexMod for those who are trying to modify their COVID-19 forbearance?
So
take that?
The Flex. Yeah, I'll take that. Yeah. So the FlexMod does require, the reason why you do the equity determination is there's either a threshold you want to determine, whether it's the equity position, trying to understand the borrower's housing ratio. It's a number of different considerations. So it's not just the equity consideration, so the mark to market. It's also a housing ratio or a payment decrease ratio that we have in our guidance. And so those three elements are all considered in that process. That would continue after the forbearance is completed, and ultimately they are considered for the FlexMod.
Okay.
Does that make sense?
I think so. I imagine that another question will come up if it didn't make sense to the person who asked it.
And Ben, just asking for Ben, is that that's the same on your side as well? I'm assuming, right?
Yeah, I mean, I think the general overall concept is the flex mod is the flex mod. The purpose is a look at payment reduction, and trying to get to a 20% payment reduction is the overall goal, and what levers are going to be pulled, and they're going to be different levers based on a number of different factors, including what your equity position is, what your interest rate is, what your existing term is, and how much we can pull these different levers in those directions. That's always going to be, we're going to keep that as the case. So while for flex mod, as you pointed out earlier, removing some of those hindrances to being eligible for a flex mod, the same underwriting for the flex mod will still exist.
Okay.
Great.
If somebody is in a deferral, can they change to a forbearance because their circumstances changed regarding, under COVID-19?
Well, if they won't already be in a they won't already be in a deferral because it doesn't exist. So that's until July 1st. Yeah, so that takes care of that. But so what the way the deferral works is you're not in a deferral. That's kind of the reality of it, right? The same way you're not in a modification, the same way you're not in that weird area once the modification has been completed, right? You're in a trial plan before you've actually completed a modification. But the deferral doesn't have anything like a trial plan. So you're delinquent, you get approved and processed for the deferral, and now you're current. With that, monies that were previously due move to the back end of the loan. That's how the deferral works. So you're not in a deferral, you're at that point a current loan, just like any other current borrower.
Okay. I will say that there are a lot more questions, but we do want to get to our next presenter. So I'm going to ask you one more question before we switch over, and that is, who should counselors contact if their servicer is not following the FHFA guidance and the Fannie and Freddie guidance at this point?
So for Freddie Mac, that would be, you can always call 1-800-FREDDIE. We have a line that's specific for, we have a direction for sellers and servicers, and then also for borrowers and advocates and counselors to use. So I would call 1-800-FREDDIE directly for a Freddie Mac loan. I know many of the counseling agencies have a direct relationship with our affordable or operational units at Freddie Mac and use them as resources as well. But otherwise, call 1-800-FREDDIE. We have a dedicated team of extremely knowledgeable people who will either get your questions answered or routed to the right area.
And I would agree with that sentiment too for us. So the 1-800-2-FANNIE number for borrowers and advocates for borrowers, you can call that. And then, Rob, from just a counseling support standpoint, I think there's some resources we can probably share after this call for connecting them. I know Cheryl is a participant on this call, not a panelist, but how do we get that voice as well? So the heads of some of these counseling agencies, some of these consumer advocacy groups can reach out on behalf of their teams, and let's consolidate that. And so I think there's some channels we can probably share how to do that in addition to the 800 number.
Absolutely, because we have our resource center out there that can field those calls as well.
Yep.
Okay, so that's very important to us, and so we appreciate that. Also, we'd love to get an inventory of all the consumer-facing portals and call-in numbers of different servicers. So if you have that, I'm actually talking with Stacey Walker at Freddie about trying to get something like that, but Fannie has the possibility as well. That would be great. And then certainly anything you can do to help create these specifically for counselor communication channels so that we are able to work on individual cases more, that would be great. Thank you very much, and you're welcome to stay.
Thank you for mentioning Stacey on that, because I didn't have a chance. I was trying to email her very, very quickly to see what other resources I could put out there. So we will put a list together too through Stacey as well. Thank you.
Awesome.
Excellent. So you're welcome to stay if there are more questions that pop up. But let's quickly go to Steve Sharp, who's been a long-time advocate, is with National Consumer Law Center and also a practicing attorney in Ohio. And Steve's job is to cover those loans that aren't covered by what they call government-backed, well, actually, by FHA, Fannie, or Freddie, and also help us think about how best to communicate with our borrowers on these kind of issues and what we should be saying. So, Steve, welcome.
Thank you. Thanks, everyone, and thanks to FHA and Fannie and Freddie. That was really useful. So let me start with a few things. So the first thing I'd like to say is a few plugs. So for counselors out there, you know, there's a lot of good resources. We at NCLC are trying our best to kind of capture what's going on. So we have a COVID-19 page of resources at www.nclc.org. I think there's some pretty helpful things on there, especially, you know, it's hard to keep everything tracked. So I think that would be a good resource. Also, a quick plug, their Surviving Debt book, which I know a lot of you use. And if those of you who haven't, we are running, we have some free access to it during this period. So you can check that out there as well. So I think what would be helpful, at least I'm thinking about it, and we can, you know, ask me questions, is to sort of kind of see what the CARES Act applies to, and then kind of figure out from there, you know, where are you left with all the different types of loans. And so I think crucially, the crucial bit of information, and it applies to what we talked about today, and it is available for links on our website, is the key figuring out who the investor is. I think that kind of is the background for what we've been talking about, but I really can't say enough that when you're helping folks, figuring out whose rules apply is more important now, or equally important as it has ever been. So for Fannie Mae and Freddie Mac, there are loan lookup tools, and you can just Google Fannie Mae or Freddie Mac loan lookup tool. For FHA, it should be pretty clear from mortgage statements or from the documents whether there's FHA insurance on it. The same thing with VA, generally on the note and mortgage, those are in big, bold terms. The USDA Direct program is going to be very easy because the lender is going to be the United States, and your client will certainly know whether they're with the USDA Direct loan, because they're going to be dealing with the servicing center there. The hardest one to determine is whether it's a USDA guaranteed loan. Those are that is a loan program that looks a lot like FHA and VA in terms of how it works. There's a government guarantee of the loan, and there's private lenders. The challenge, though, is there's nothing really clear on a lot of the documentation that I've seen. So a lot of the tells might be if there may be on the documents, client may know. If someone says that there is a farm loan, they have a farm loan and they live in a clearly non-farm space, that may be a good tell that is a USDA guaranteed loan. And why that is so important is the CARES Act application. It applies to federally backed loans, and those are the main categories of federally backed loans. Now, you may think that that sounds like what applies for RESPA. So the Real Estate Settlement Procedures Act, where we get those great notice of error and request for information rights and some of the other rights, it has a much broader scope when it applies to federally related, but this is not that. This is a narrower scope. Still most loans, but narrower, where it's only those federally backed loans. So, you know, I've heard where federally related could apply to like in the 90% of loans. The federally backed is only going to be like 60, maybe, you know, around 65, 2/3, maybe a little more percent of the loans where it's Fannie Mae, Freddie Mac, VA, FHA, or USDA. So there is a big hunk of loans that are not covered by the CARE Act. Those are those private label security loans, or the ones held in portfolio by banks, those are really the ones where, unfortunately, there is not a federal foreclosure moratorium that applies. And so, I think if there are borrowers who need help right now, those are the spaces. So there's going to be, hopefully, a lot of the larger servicers are, implementing their own programs, maybe 30-day or the 90-day forbearance programs. But, it's really good if folks who are handling those and see particular problems can share those out. I know Bruce and Ellie have reached out to counselors to sort of share what they're seeing. And I think if you are helping folks in that non-federally backed space, to kind of know what's going on is key. Of course, state foreclosure moratoria, I know we have people from all over the country, are different. And hopefully some of those apply for where you all are living. But that, and that could be broader depending on what the state itself has done. But in terms of the CARE Act, when we're talking about moratoria, it is for those federally backed loans. Now, what's critically important, though, for those federally backed loans in the CARES Act, is that moratorium is not limited to COVID-19 hardship folks. Let me repeat, the moratorium provisions of the CARES Act are not limited to those facing COVID-19 hardship. So I think that, to the extent that you're watching what's going on for folks, I think that is really critical. Still federally backed, but not necessarily, or not for just COVID-19 hardship loans. What's nice about the moratorium in the COVID-19 language, in the CARES Act language, is that it does not just apply to sales. So the initial Fannie Mae and Freddie Mac announcements from March 18th were only a suspension of sales. But the moratorium in the CARES Act applies to things like initiating, moving for judgment in a state that's a judicial foreclosure state. It's just a much broader moratorium, or broader language in the moratorium than a lot of the initial releases were. So I think that's pretty important as well. But it is only for those 60 days. And, I think there's a real open issue about, how long this is going to last, especially as Bruce noted with the unemployment numbers as they are. We're already, 14, 15 days in to that moratorium time. So, I think it's going to get crucial here for borrowers shortly. So then let me just tie up on federally backed. We had a lot of great information from Fannie, Freddie, and FHA. That those forbearance provisions also apply to USDA and VA. And in fact, as we were talking, USDA just issued for its guaranteed loan just a clarification that, of course, the CARES Act forbearance provisions do apply to it. So that is good. And then VA, I haven't seen if there's a updated VA announcement yet. There was an initial VA announcement around March 19th, but I have not looked, and maybe they just issued something today as well. So that is, again, the CARE Act forbearance should apply to them as well. And then, so, if we divide this up into pieces between first moratoria, then forbearance, then, what are you going to do after the forbearance? FHA just talked about how they just released yesterday what their post-forbearance plans are going to be. Fannie and Freddie, we've heard just now about cap and extend. I do not believe VA and USDA guaranteed have issued anything yet on what the modification or post-forbearance options are going to be, but I'm sure that everything is moving quite fast, and I probably could have just looked over at my computer, but that is how quickly things are being updated. So I think that's really the key. But again, we're back into with the private label securities, so those loans that aren't federally backed. Again, we're in a tough space here because we no longer have HAMP for those loans. So just to be clear, we were already in that space without the uniform modification program that we had for a very long time with the Home Affordable Modification Program. And so now we re-enter that with this COVID-19 crisis, and we don't have the clear federal forbearance, nor do we have the uniform modification program. So again, I think these are really cases where it's important to know what folks are seeing and what's available. So, the more you can help those folks and also share out what people are being offered, the better, because it is significant that fairly large segment of the mortgage population does not have right now a clearly defined modification program. So that is, that part is, unfortunately, I have the part with a lot of the less hopeful side. Hopefully we can, as we help cases and we talk about what folks are facing, we can, continue to push for better outcomes for folks, because, we know that there's going to be these defaults. In terms of practical, I think when you're helping folks, I think for one, making sure we all know what's going on, and not only sharing what you're seeing in terms of options, but I think it's also critically important to share out what customer experience is like in terms of, are you able to reach? Are people being able to request a moratorium? And what ways are working? Or not a moratorium, I'm sorry, but a forbearance. We heard about the need for people to reach out, but if we're not being able to get through, if their phone line shut down, I think that's really critically important to not only help borrowers manage, but to share out, because as we heard, that is a requirement that Fannie and Freddie have, and also FHA. But then I think it is about all of that being over, have a plan for what they're looking for. So I not only understand what
Steve,
available,
you're breaking up
plan. Oh, that's weird. I'll keep talking, but it shouldn't be.
Oh,
Perfect.
that's better. I don't know what you just did
weird.
different, but that's better.
Who knows? Sorry, thank you. You never know. So I think having a plan, helping people with a plan is incredibly important. And that plan should include escrow. What I'll say about escrow, it's not, the general rule of thumb is, if what the plan is, if folks are going to need to do a modification or have something where the terms of their loans change, escrow should really be folded into part of that. It is if there is a payment plan or something where they're going to have to account for things outside of a modification, where just having folks have some money left extra in case there's escrow issues, in case there is a reassessment of their escrow account in the middle. I think that those are all just things to look out for, and I would say that all fits under, people should, have some, if you think you can do it in a payment plan, making sure you have enough money set aside to kind of weather potential increases, potential changes in what the escrow could be are really important. And I think why that is important is if you're thinking about counseling people who are like, no, I need to just do a payment plan, I don't want a modification, versus someone who maybe does need to think about a loan modification. I think that sort of part of it is really where escrow can fit in. So I think that covers, I think we'll leave it. We have so much, we've talked, had a lot, I'm sure there are a lot of questions out there. both that I could either answer, and I'm happy to talk about my perspective on what we heard from Fannie Mae and Freddie Mac and FHA, or anything that I've said. So Ellie and Bruce, so many people, I suspect there may be questions. So why don't I leave it there, unless you think there's another part of this you'd like me to cover?
You know, I have to say that I would like to hear your perspective on, as an advocate, on what you heard from FHA and the GSEs. The kind of questions that are coming are not specific to your conversation necessarily, but so go ahead and give us your perspective.
Well, I think that I think there are still, the key here is, I said how important it is to know what's going on in the private label securities. I think it is equally important to know what's going on the ground with servicers on Fannie Mae and Freddie Mac, and FHA. I was encouraged to hear that Fannie Mae, although I wasn't sure where that ended, I was encouraged to hear that Fannie Mae said that we could have more than 2 forbearance plans, that it could total up to 12 months. Or sorry, the Freddie representative said that. So I am glad to hear that. I think I understand the need for borrowers to start making payments when they can, meaning, if you can start making payments, there's a real value to that, because you don't want that arrearage to build and build and build. That makes sense to me. But also, if you're sitting there in an initial forbearance request, and not knowing how easy it is to get in touch with servicers, and you've got one, I think, the more asking for the more time, if you don't know what's going on, just makes sense. And I'd really like to hear, I asked them for the 6 months to be specific, and I would like to hear what is actually happening and whether people are being able to get that year if they need it. Of course, we're very early, so I recognize that, but this is this will maybe a long default period. So I think on that forbearance, that was good to hear. One thing that is unclear, so to be clear on the FHA side, that mortgagee letter was just released at like 8 o'clock last night, so I haven't really even had the time to digest it fully. I think some of the same forbearance issues would apply to what's happening there. I think that there is still a lot of open questions to ask FHA about, that people already raised, about whether, I like the question about whether if people already have the max partial claim already, are they precluded from a partial claim? I think there's also a question about, are there going to be any specific loan modifications, a loan modification program for people in disaster? I think that that's an open question, or whether we're just going to have people go through the standard waterfall. I think there's a really, the question about trial plan deferral and deferment of trial plans and forbearance on trial plan payments are very real. Those are all questions that, if you had someone who is got a new job, was in default, got a trial plan, but now has fallen behind, I would hope that the forbearance applies to them and they can stay active in the trial plan. But I think that is a question that FHA we need to hear more guidance from FHA on. So, this comes back to what you all are seeing. We at NCLC are planning and are going to soon release our request for folks to fill out stories of what they're seeing on the ground. And what we want to do is make our survey one that can be used throughout the crisis, meaning we know that there's, as someone who is representing folks in the last, from the very beginning, if not before the last foreclosure crisis, we know what we're going to see in terms of problems with eligibility, problems reaching servicers, all of those issues. we want to be ready right now, learn from that, and be ready right now to share those stories. And so that's what we're going to do. But I think those practical questions that you all asked are really important, and we need some answers. The seasoning question, you all know this stuff, and I think the more you can ask these questions and try to push these things out, the better, because there's a lot of things we don't know right now.
Well,
So
I'd like
Steve,
to
there
just
is
emphasize one thing. Let me just add one thing I think that was a very clear takeaway is that when you're encouraging people to raise their hand to ask for forbearance, that we should be asking for 6-month forbearances.
Sure.
So people can use less. They can always end it earlier if things get better, but you should go for the max 6 months, and then assume that if things aren't better, that you may go again for a second 6 months to make sure people can get the total 12. So I would say that's a best practice in the area.
Yep, I don't see any problem with that. Yeah.
And the specific question that somebody has asked, Steve, is what are the rights of homeowners who are attempting to contact their servicers and their servicer is unresponsive, or they, because of the volume, or they aren't, offering what they really ought to be offering? Do you have thoughts around that? I mean, I know Fannie and Freddie and FHA all said they want to hear if those problems are happening, but just from your perspective.
Well, that's an interesting question, and I think that let me say what the CARES Act says. CARES Act, one of the good things about the CARES Act is it says that, and I think Fannie and Freddie actually said this pretty well, is that it says upon request from borrower for forbearance, such forbearance shall be granted for up to 180 days. So, I think this is not for federally backed loans. It's a shall, that this is, if you have a COVID-19 hardship, the forbearance is required. Now there's all of this, like the time period, and I think Bruce is totally right, that you should ask for 180 days. How this is going to play out if people aren't able to get through the servicer is going to be interesting to me. I think from a lawyer perspective, I always want to try to find a way to enforce my clients' rights. So I think that's going to be part of it. But I do think that being, from a counselor perspective, being persistent and being clear that this is we have said what we needed to say, and the borrower shall get forbearance is important. And then I think, or like I said, echoing Bruce, if you're sitting there with a client who is unemployed and doesn't really have a clear, and probably wouldn't have a very clear understanding of when things are coming back, I think asking for the 6 months and hearing what the servicer says is good practice.
So on the rights question, the other thing that Fannie and Freddie have offered their 800 numbers, and we should obviously use them on Fannie and Freddie loans. We'll try to figure out if there's a special thing we can have at FHA. And then, of course, documenting this and getting it into these various, we've got one, and then CLC has one, we surveyed so that information is getting out there. Is there any point to thinking about the CFPB in this? Is that, only so much time you have on each individual case, but it used to be a kind of vibrant hotline for reporting things. What do you think about that, Steve?
Well, I don't know why you wouldn't complain to the CFPB. I mean, I don't know what will happen with that is to be determined, and hopefully we'll have some stronger guidance out of the CFPB at some point. But from a counselor perspective, encouraging a borrower who isn't getting a forbearance to complain to the CFPB still seems like a good idea to me.
I'm just going to throw quickly throw up the CFPB website, their page about the guide to coronavirus mortgage relief options, where you can find some answers here. So just, that's in the chat box if people want to copy it and have it for themselves. So the other thing that I want to point out, and Bruce, maybe you can speak to this, a couple of people have asked about funding for all of this work, and also about you know, a list of counselor-only lines. You talked about it a couple times, but if you just want to summarize those again.
So we are not part of the bill that passed just now, that we tried, but we are in active conversations with the next bill that's pending that would come out of the House. We're working with House Financial Services Committee and Chairwoman Maxine Waters' staff. There's a proposal for $700 million in HUD housing counseling funding, and we're encouraged that she's been a strong supporter. There are other strong supporters there. A lot of this has to do with getting it through both the House and Senate and White House and those negotiations. We're all over this. Others are working on it as well. So we're really trying to push this in every direction we can, but not assured at this point. Certainly, you heard from Brian Montgomery from HUD and Danbury Carmen saying that they were trying to work on getting the current NOFA out, the current housing counseling contracts out, and getting them in the system. So those aren't available yet, but it's clearly an area of some attention. A lot of us have raised that with them, and we'll continue doing that. That's not new money, that's existing money, but it's a piece of the puzzle. In terms of the hotlines, boy, anybody can do to help with this. I put a lot of work into this for the last week or so, and I'm pretty surprised how little there is there, but we will be getting some of them from some of the servicers, and we're working on trying to get a much better list from everybody. Hopefully Fannie and Freddie can be some help on that as well. We'll see, and we will absolutely circulate this once we have it available.
And one other thing, so one of the agencies commented about they haven't really been hearing from consumers. They think maybe consumers think that the agencies are closed. So, you know, something that we've been talking about is how to get the word out and do outreach to let consumers know that you're there. And something I think that everybody, all of the organizations can do pretty simply and pretty quickly is email your previous homeownership clients. Let them know that you're open, that you're available, that you can help them through the process with the COVID-19 forbearance program or any other questions that they might have. Same for tenants if they have any questions. So just doing some of your own initial outreach on that. And you know, I know that Bruce and Melody have been working hard on making sure that outreach is part of any kind of funding plan, so that groups have the opportunity to do that.
I do think your old client lists are a gold mine for this, and they were vulnerable at one time. They're likely to be vulnerable again. We don't want to lose the progress we made through all this, and this is really worth concerted effort. So I mean, I would figure out how to pull all the email addresses out of the files, do robocalls, do individual calls, however you can get to it. But going deep and long there, that would be meaningful work that will produce clients. I think what we're seeing is some agencies are getting flooded and some agencies are not. And you know, we would love to see that balance out, but some of it is also going to be on your agency to kind of reconnect with people.
So that is it for the questions. Steve, I don't know if there's any final words that you'd like to say before we move on to the final portion of our agenda.
No, and I appreciate the invite and really encourage folks to keep up their amazing work and persevere. Thank you for what you all do. And I really appreciate it. Share those stories. And then I think I'm going to sign off. So thanks, Bruce and Ellie, for inviting me.
Great.
Thanks, Steve.
Yep.
Okay. Thanks, everybody. Well, we have 300 people still on the call, so that's great. Quick plug for joining NHRC if you can right now. It's very helpful. If you can renew your membership dues, that's great. We love the support. Understand if it's not the right time for you, but if it is in your organization, that is very valuable for us. And so next week for our next call on the 2nd, we are going to have the National Housing Law Project on the evictions policy. We may also add some other pieces to that. So that'll be helpful. And you should definitely plan on joining us for the call. Also be thinking about what materials and what resource things would be helpful to you while we put these together, and you can reach out to me or to Ellie or to Melody, and let's we're very interested in figuring out how to be the most useful for you going forward. And with that, thanks for all your good work, and we will and we're going to start the next one at 1:15 again Eastern, and that'll be April 9th, this coming Thursday. Thanks, everybody. Be safe out there.